Okay, good morning, everyone. Welcome to another VAM seminar. Today, we're very glad to have Feng Zhang here to present his work on return horizon and mutual fund performance. It's joint work with Mike Cooper and Hank Bessenbinder. Feng, the floor is yours.
Yeah, sure. Thank you, Skada, for the introduction, and thank you for having our paper on the program. This is a great platform, obviously. This is something very good, I think, for the whole profession. It's joint work with Hank and Mike. Mike is here, and Hank probably will join us a bit late. As you can tell from the title, it's a paper about mutual fund performance, but our focus will be on return horizon. Unlike most papers in this area, which focus on monthly beta or monthly alpha, we say, hey, let's think about a different dimension of this performance measure. In particular, we want to look at the importance of a horizon. There is something in a finance research history. Let me introduce that history to you. In the 1960s, the CRISP decided to assemble, to have the data, right, for our researchers. At that time, they had a board meeting. They thought, well, we need to report returns, right? What should we do? Should we report daily return or weekly return or other horizons? And they decided, well, what should we do? We are going to report monthly returns and let all the researchers just use monthly returns. And we follow their advice, and then we just focus on monthly returns. If you read most papers published in finance, you realize most of them focus on monthly returns, right? So, well, should we really focus on monthly returns? I will come back to this. But what I said is just a spoof, this is not true. This didn't happen, or at least we don't know why they decided to report monthly return. And more important, it's why most people just focus on monthly returns when we do research. Why we just focus on monthly returns? Is it about a theory? The theory tell us that's the correct horizon? If you go back to 1960s or 1970s, the factor models later on in 1990s or even more recent factor models, if you read their papers, they won't tell us, well, what's the horizon either. They would say during each period, what's the return, what's the market return, and what's the relationship. But how long is the period? We don't know, and they didn't specify. Then how about investors? Do investors tell us they only care about monthly returns? We don't know, because different people have different investment horizons, right? They are day traders, and many of them may rebalance over months, and others may hold their portfolio for decades. For example, many 401k investors, they won't change their investment once they fix it. So this is an important question. That is, investment horizon should be different for different investors, and theory doesn't tell us what should be the investment horizon. And if you think carefully about this problem, actually all important parameters for returns, for betas, that's risk, are different depending on what's the investment horizon. Out of the following parameters, including the mean return because of compounding, okay, the variance, covariance, skewness, and beta. Back to 1970s, researchers already realized this problem. Actually, there are some theory papers on this. And more recently, Hank and Mike and I, we all look at investment returns over longer horizons. For example, long run returns after corporate events. So investment horizons do matter. That's what we want to say. Then why people focus on short horizons? There may be some reasons. Let's think about those reasons. First of all, some people may say, Well, let's think about investors. Probably many investors make decisions over short horizon. For example, they may choose to rebalance their portfolio monthly, right? But meanwhile, this doesn't mean all of them will do the same, and many others have a longer horizon, right? It could be years or even decades. And if you think more carefully about this question, even if you rebalance your portfolio monthly, we believe longer horizon betas and alphas still matter. Why? Suppose you rebalance monthly, you change your mutual fund choice or investment every month, but still, when you care about when you compute your alpha or beta, there is still a difference, right? Do you only care about the monthly alpha based on monthly return, or do you want to care about your annual beta or annual alpha? It's still a question. But then some of you may still say, wait, doesn't theory tell us the optimal portfolio weights don't depend on investment horizon at all? This is the early literature back in 1960s. For example, Samuelson in a classical paper told us if you assume IID returns, and also if you assume expected power utility, yes, that's true. That is your portfolio weights don't depend on investment horizon. But these two conditions must hold. And Mawson in the paper in the 1968 paper already points this out. But returns are not IID, and not everybody has expected power utility, right? And what do we do in this paper? We not only show that other parameters I mentioned in the previous slides depend on return horizon, we show here, we emphasize for the first time, alphas also depend on horizon. And this is important, right? And it's relevant for performance measurement and also to asset pricing tests. That's why we believe this is an important research question. We want to look into this. What do we do exactly? We introduce a new method to estimate long-run beta, and also that will allow us to estimate long-run alpha as well, long-run beta, and also long-run alpha. So based on this, in these new methods to estimate them, we believe this is a methodology paper. You can use this to evaluate performance and also test asset pricing models. But in this paper, we in particular focus on mutual fund performance. We want to emphasize that the method doesn't just apply to mutual fund performance. Later on we could potentially expand this to other financial assets.
Feng, it looks like you might have a question.
Wonderful.
Oh, sure. Yep. Question?
I really like the question that you're asking. I get it. But what I'm looking for, and I haven't finished the whole paper yet, but I did read Hank's paper on individual stock returns. I thought that was very interesting. So are we going to talk about, am I going to learn anything about the underlying distribution of portfolios that's driving some of these different techniques or different measurements, I should say? Or are we just going to talk about, well, we're going to change the horizon, that's important to investors, and here are the results? So I guess my question is, and I haven't finished the whole thing yet, but are you going to teach me anything about the distribution of these portfolio returns that I should know?
Yes, I think when you say distribution, do you mean let's measure monthly returns or decade returns? What are the distributions, those parameters? Or are you talking about the parameters that would change the measure of a beta and alpha?
No, well, I go back to like Hank's paper. I looked at that distribution and I said, wow, I kind of suspected this, but that's going to update how I think about, everything in investing. Normality, portfolio theory, that asymmetry is really important. So you've actually done the work and you've gone in and put the portfolios together and you're looking at different horizons. Is it underlying Cauchy? Is it the fat tails? Is it the asymmetry in returns? is it or is it just we're just going to change the time period and get different results for investors?
Yeah,
So
now
what's
I
the
got
underlying flaw from normality that changes all this? I guess not flaw, but divergence from normality that produces all these results. That's the question. Thank you
Yeah,
very
thank you, Paul. I think now I got what. Yes, I'm going to tell you why. Yeah, what caused the results. I'm going to first present you some results that are similar as Hank's paper, which focus on individual stocks. We're going to do that for mutual fund returns, and you will see that the asymmetry is mainly caused by skewness. I will show you because the skewness of stock returns will be growing quickly as the time horizon increase. But that's only the first part. I'm going to show you its skewness. If we just focused on the summary statistics, that's more about the skewness. And then when we move on to the long run beta and long run alpha thing, it's becoming a bit more complicated. Over there, the driving force are from two things, both the covariance and variance. Both the covariance between mutual fund return and market return vary with time horizon and in a complicated way. And also the variance doesn't grow just linear. It's also growing in a more complicated ways. So these two things will be driving our results on long run beta and alpha. So Paul, I will, definitely talk more about the driving force a bit later. But thank you. That's a great questions. As I mentioned, this is just a methodology paper, and we want to make people be aware of the importance of an investment horizon. So this paper is not about. It's not about forecasting. We're not trying to say once you know a short horizon performance and then use this to forecast what's going to happen in the longer horizon. It's not about that. It's not about learning about the distribution of returns from the short horizon and then try to learn it or what will be in the longer horizon. Or we are not trying to estimate the time varying parameters. This is not a conditional asset pricing model. It's not about those, but it's more about the method to assess the performance of mutual funds and also potentially other financial assets. The punchline of this paper is very simple. We show that the long horizon returns contain different information. That is different message for short horizon returns. You will see some of the results are really shocking and hopefully will change how people think about the question about time horizon. The plan of the presentation will be, I will talk about the data and then give you some summary statistics about how the returns will be changing over different time horizons. That's the first part. In this part, I will emphasize the importance, as Paul just points out, what's driving that? That's a skewness. I will emphasize the importance of skewness. And then I will move on to how to estimate the long run beta and alpha. All right, so two parts. Let's start with the first part about the distributions of the returns over different horizon and the skewness. Our data, I don't want to spend much time on this. It's pretty typical. It's from the CRISP mutual fund data, and we focus on the period from 1991 until 2018. We start in 1991 because the monthly TNA data became available then. Since we want to focus on active domestic equity funds, that's why we exclude ETFs, target date funds, hedge funds, and commodity funds. Another trivial thing is we have to exclude funds with very short horizon because we need to compute their monthly beta, right? So if you have too few months of returns, that's going to be challenging to do that. We also aggregate returns across different share class. Obviously, there are some data errors, so we try to clean, by manually looking into other data sources. So our focus. First of all, I'm going to present summary statistics of mutual fund returns over 4 horizons. The monthly, which is reported in CRISP, right? And also annual, decade, and lifetime. When I talk about lifetime, I mean for a fund that survived 5 years, that's 60 months. Lifetime means 60 months for this fund. If a fund survived 6 years, the lifetime means 6 years. So it's different for each fund when we say lifetime. And we also want to try to compare what's the return to mutual funds over different horizon to a benchmark. We want to focus on the benchmark of SPY ETF. Why? Because it's attainable, right? People can just buy and have the returns. Of course, we also use the CRISP market return, although researchers cannot easily get that return. Anyway, we have 2 benchmarks, the market and the SPY ETF, and we focus on SPY ETF. This is a summary statistics for the monthly returns. You probably all have seen this many times in other papers. All right, so the raw months of fund return is about 0.63%, market return 0.7, and SPY also about 0.7. We also look at the risk-free rate. And I want to emphasize one thing, because I will draw your attention to skewness and show you skewness is important. Okay, if you look at a monthly return, it has actually a negative skewness. You will see how this will change once we move on to a longer horizon. And about 46% of them outperform market over monthly horizon. 47 outperform SPY and 55 outperform T-bill. I won't talk about those. So these are the basic summary statistics. Now let's move on to annual. When we say annual, we mean calendar year. All right. If a fund has only 11 months or 10 months in that calendar year, we still call it annual or a year. On average, that's why the fund life is not 12, it's 11 months in this over this horizon. Now, look at these 2 measures. How many of them will outperform the market and SPY? 38%, 39% of them outperform the market, and about 40% outperform SPY. And this is something Mike really like. Only 60% of them outperform RF, risk-free rates. Okay, this is shocking. I will show you a bit more later. This is even more shocking. Now, let's focus on what's the skewness of the annual or the yearly return, yearly buy and hold return. It's not negative anymore. Remember, over the monthly horizon, it's negative. It's a negative 0.35. Now, it becomes positive. All right, because of this skewness, the fraction of the funds that outperform the benchmark, the market or the SPY, has been lower if you compare here to the slide before. That's for annual returns. We are going to do the same for decade return. All right, for over a longer horizon, over a decade, what will be the skewness to the buy and hold return over 10 years? It's a 2.9, almost 3. And what's the fraction that the fraction of the funds that outperform the market and a SPY, it further decrease. All right, and now this is the shocking part. Only 58% of them even just outperform the risk-free bonds over a decade horizon. Only 58% of them. Now let's move on to the whole life. Over the whole life, over fund life, the buy and hold return now is the skewness is 4.6. It's very high. If you look at what should be the skewness of a normal distribution, that's 0. Now it's 4.6. And what's a fraction that's going to outperform the market and a SPY? 24% of them now outperform the market, and 30% outperform SPY, and only 76% of them outperform T-bill, the treasury bill. All right, so what can we see from this simple summary statistics? Most equity funds, mutual funds, underperform the market benchmarks. And this underperformance increase with return horizons. The thing is about the skewness. As the time horizon increase, the skewness of the buy and hold returns will be increasing and making many funds unlikely to beat the benchmark. All right. And even if we are here talking about a rebalanced portfolio, the mutual fund portfolios are rebalanced on a regular basis. All right. The key here is skewness, and based on the skewness, the fraction of funds that outperform the benchmarks will be decreasing over different time horizon. That's the key part. All right. If you have any question, feel free to raise.
Clemens has a question.
Sure,
Clemens
Clemens.
asks, how does the paper relate to Lina Inma's reverse survivorship bias? Poorly performing funds discontinue and therefore have shorter lifetimes.
Yeah, it's a very good question. So yeah, first let's look at the reverse survivorship bias, what it says. It says, well, some funds, they may have negative idiosyncratic shock to their returns, right? That's why they have to end their life early, right? So they are liquidated early. That's why you don't observe what will be their performance later. This introduces this reverse survivorship bias. Indeed, there is a bias, and we believe some of this underperformance will be from reverse survivorship. And right now we are working on it. There is no clear solution to the reverse survivorship bias, right? One solution would be you look at what's the alpha and beta, or what's the return of the portfolio. But here we cannot easily we haven't looked into that. All right, we haven't. In the later version, we will have the results. We already produced the results. That is what's the portfolio alpha and beta, the portfolio of all mutual funds. And we find that even if you look at the portfolio, horizons still matter a lot. So Clemens, the horizons still matter for the portfolio. That means even after adjusting for the reverse survivorship bias. I didn't include the results in the slides, but we already have those. Thank you. And we believe many of these underperformance could become from reverse survivorship. And another thing we did here is, although it's not a great solution to the reverse survivorship bias, we try to weight the buy and hold return of each fund by their life. That is how many months they survive. And we show that, although the results are not here yet, but we can see that even after we give different weights to funds that survive different periods, the underperform will still be there. Not only in this slides, but also when we talk about the beta and alpha. That's something we are still working on, and we received that comment before and really working on that. Paul, do you have a question?
Yes, thank you. Having a hell of a time finding the, well, never mind. Okay, tell me why. Very interesting, sort of expected mathematically, I think, but why do you think that the fund skewness is so much bigger than the spider skewness or the market skewness? That would be interesting, I think.
Yeah, that's a very good observation. Let's go over the different horizon annual, for example. If you compare the skewness, the fund skewness is much higher than SPY and market. This is also true for decade and also for the whole life. Our thought is part of that is about the variance. We believe on average, the mutual fund return are more volatile. And those volatile returns, and another thing could be there are fixed effects. That is, there are some funds that really have the ability.
Just because I know, like Oliver Hanch's stuff, mutual funds and things I've read, the mutual fund beta is on average is pretty close to 1.
Yes.
Maybe 102, maybe 0.97. So why should I presume that they're more volatile?
I would say if you compare their idiosyncratic risk, that will be much higher. than SPY, not just the beta. If you look at the idiosyncratic volatility.
Okay, so is this just a mathematical thing? Jensen's inequality differs?
I would say yes, you're right. In the end, it is about the Jensen's inequality. You're very right. Another way to look at this is when we talk about buy and hold return over long horizon, you can write buy and hold return as an exponential function. It's an exponential of the sum of your log return in each period. That's the thing. And
Well,
the log.
Sorry, I didn't mean to
Yeah.
interrupt you. I said that's important,
Yes.
but it's less interesting than if it was something funds were doing that was enhancing this difference. Merely an editorial comment. I'll go now.
Yeah, I think that's, I would say another contribution could be for here we are looking at the skewness of the return across different funds, right? So for different funds, their performance could deviate from the market by quite a lot. And if you compound that difference over a long horizon, I think that will also contribute to that skewness. Paul, did that answer your question?
Yes, sir. Thank you.
Yeah, thank you. All right. That's the part about the summary statistics about the returns over different horizon so far. But then you may be still wondering, wait a moment. You're just telling us about the summary statistics, and that's interesting. But as Paul points out, well, it's not that all funds have exactly beta of 1, right? So you're comparing a fund, if you're comparing a fund with a beta smaller than 1, of course, over long horizon, you're going to underperform the market, right? Over long horizon, that's true. So what's the solution? We have to look into alphas and also betas, right? How to look into those. And then this will become more challenging. When you try to say, let's get rid of the risk part. So far, the long horizon underperformance of mutual funds with respect to SPY could be coming from the low risk, right? The thing is how to get rid of the risk part over longer horizon. That's challenging because previous research already showed that Lihari and Levi, they already showed that beta depend on return horizon. They show that in mass, but they don't tell us how to estimate long horizon beta. It's really challenging how to do that. All right. Before we talk about how to estimate that, let me give you some basics about why the long run alpha and long run beta will be different than short run ones. First of all, let's make it simple. Okay, assume a zero risk-free rate and long horizon is n months. Okay, let's think about a 1 month versus n months. All right. The model is very simple. We are going to make some assumptions that look probably unrealistic, but give you the idea. This, if you look at the short run alpha and beta, this is a relationship. Suppose this is monthly. For fund I, your monthly alpha equals to your expected return, expected monthly return minus your monthly beta times expected market premium, right? Monthly, everything monthly. Now, in the second equation, we give it a notation L. This means a long horizon. You can think it's 1 year or 10 year. That's the same expression, right? So based on that relationship, if you assume IID returns, of course, that's too simple, but that will make our math really easy to follow. If you want to assume non-IID return, the expression will become way more complicated. Based on that relationship, you can also write your long run alpha as a function of this. Why we have this is just one plus your expected return over each month to the power of n minus 1 minus your beta. But here now it's your long run beta times the same thing. This is the long run market premium. All right. This relationship now, if you just look at this equation, what's the relationship between your long horizon alpha, this is alpha on the left-hand side, and your monthly alpha. The relationship is not linear, first of all. It's way complicated. And not just look at this part. And also I will show you even this beta, this long run beta will also be a function of a short run beta and also your short run alpha, making the relationship really complex. All right, I will show you very soon. And the relationship between long horizon alpha and short horizon alpha is simple if and only if you assume the market premium is zero. But this is obviously not realistic, right? So to really understand the relationship between long horizon alpha and short horizon alpha, we also need to understand the long horizon beta, how this guy will look like over a longer period. And fortunately, back in 1970s, Lee Harvey and Levi told us so. All right, in their paper, they show this will be the covariance between fund I's return, long horizon return, and long horizon market return. This will be the covariance. You can see that this is a function of a power n, and also it involves their short run covariance, their expected short run return, fund return, and market return. That's covariance. If you look at this part, this is the derivation of the long horizon beta, which is just the covariance divided by the variance. It's a function of your short run beta and also your short run expected fund return, which go back to your short run alpha. So just imagine you put this guy, equation 6, put this guy to equation 3, replace the beta I over the long horizon. Then everything, this will make people's head explode, as Mike correctly points out. The function become way complicated now. So to understand how alpha or the performance will be changing over different time horizon, that's the basic thing, the theory. In order to understand what's the relationship between short run beta and long run beta, we don't want to, bore you with those maths. Let's look at the some simple graph. Here we assume what will be the market premium over the short run, and also the standard deviation of market premium. And let's focus on the 10-year horizon. All right. In the figure, we have annualized short run alpha at different level, -6%, 0. That is no abnormal return. Here is a positive, here is a positive abnormal return, negative abnormal return, and no abnormal return. Here is a relationship between short run beta and long run beta. Here's one interesting fact. The short run beta and a long run beta will be equal to each other if and only if the true beta is 1 and the true alpha is 0. Only at this point. In pretty much all other parameters, they are not the same. And of course, they are still positively related to each other. You can also see this from the relationship I just showed you in the previous slide. They are, of course, still positively related, but that relationship is more complicated. And in general, they are not the same thing. They are different over different investment horizon. Now let's move on to what's the relationship between short run alpha and long run alpha. All right. Again, we have the same parameters for different levels of short run alpha. And here we plot the annualized long run alpha or long horizon alpha, depending on different level of beta. The key thing we learned from this figure is, let's first divide this figure, this graph, into two parts. On the left of a beta of 1, or on the right. What do you observe? That means if you look at the left, on the left, so the long run alpha is always smaller than short run alpha if beta is greater than 1. If beta is smaller than 1, that's on the left hand side. Long run alpha is always greater than short run alpha. Let's focus on this one. For example, when beta, short run beta is smaller than 1, your long run alpha, it's this, always greater than the level of your short run alpha, which is assumed to be 0 here for this line. It's always greater. This is true for the other two lines as well. But once your beta is greater than 1, the opposite is true. Your long run alpha is always smaller than your short run alpha. What's the implication? The implication is if some mutual fund manager, they have a high beta, short run beta, and they also tell you they have great short run alpha, monthly alpha. Don't believe them, because they have greater than 1 beta over long horizon, their performance will look poor. All right, that's the implication. On the other hand, if a mutual fund manager has a beta smaller than 1, that means its long run alpha will be better than the short run alpha. That is, this fund will generate value for investors who care more about the long run, the longer horizon. All right, these are the implications from the figure. And if you haven't, sure.
I have a question. So I understand the implications, but what I'm struggling with is the intuition for why these graphs are the way they are. I understand there's some mathematical reason. Well, let's say you go back to the graph before this, the beta graph. Why is it that the negative alpha and the positive alpha, let's take a slice, okay, the beta of 1. Can you just give me some intuition as to why moving from a -6 alpha to a +6 alpha impacts the relationship between long run beta and short run beta in this positive manner? Is there some intuition you can give me?
Yeah, very good. So I don't want to go to the previous slide because it involves math. But in short, let's think about two funds with different alpha, one positive, one negative, right? For the one with negative alpha, that means your compound return over a longer horizon, because you have negative alpha, right? Your compounding return will be decreasing at a higher speed, right? Because you have a negative alpha, relatively speaking, for than the one with positive short run alpha, because you are going to accumulate that. And that accumulation intuitively will change how your returns, how your long horizon returns will be correlated with the long run market return. That's the intuition. That's all. It's going to affect.
So let me try and sort of give me one more statement. And if the market risk premium was negative, would this relationship be flipped?
It's a good question. I have to go back to the intuition. If it's a negative, I haven't looked into this. I can easily do this, changing this guy to negative, right? But I believe your intuition is right, because the way how your long horizon return, the correlation with your long horizon return will be correlated with the long run market return may be changing. Honestly speaking, I'm not 100% sure yet, but I think you may be right. It may flip depending on the sign of the market premium. Is it positive or negative? Yeah, I'm not 100% sure. Thanks.
Thank you.
Any other question? All right, the math is boring, obviously. So, what do we learn from that boring math and also the two figures? The key thing we learn are the following. First of all, the sign of alpha could flip depending on horizon. That is, a fund with a positive alpha, a positive monthly alpha may have a negative long horizon alpha. All right, that's one thing. And also, making it complicated, your long run alpha depends on not only your short run beta, it also depends on short run alpha and other parameters. All right. More important, we want to emphasize one thing, that is the relationship is asymmetric. The long run alphas will be relatively better if short run beta is smaller, that is below 1. If it's above 1, the relationship is exactly the opposite. Long run alphas will be worse than your short run alpha. That's something we want to focus. In our test, we are going to focus on that. That's the things we learned from the math. And what are the implications? The implications are simple. If you read the mutual fund literature, pretty much all of them are saying, hey, we want to measure the scale of mutual fund managers using their alpha, monthly alpha, by the way. And here we are saying, look, you have to think about a horizon, okay? Short run alpha won't tell you everything, and the relationship could be different depending on the horizon. So back in 1968, Jensen explicitly motivated alpha based on the state-of-the-art factor model back then. That's the CAPM, right? But if you look at a more recent literature, this paper by Chernov and Lockstor and Alonji, it's a recent paper. They told us already in their paper, if a linear factor model that holds at one horizon, that is, suppose at a certain horizon, you'll find a no abnormal return for one financial asset. But this doesn't work at a different horizon. That is, this linear factor model won't work, won't produce you a zero alpha over a different horizon. A model is true at one horizon, will not be in general be true at a different horizon. We are pretty much also telling you that, the alpha will be different. All right, not about a factor model, but it's also true. The alpha will be different depending on what investment horizon we are talking about. But a tricky question. Yep.
Vikas has a question.
Yeah, Vikas, please.
Yeah, sorry, go ahead. Why don't you finish your point and then I'll ask it.
Oh, sure, thank you. So the question is, which horizon is relevant or is correct? The answer is, sorry, we don't know, right? You have to ask specific investors. And from the point of view of the researcher, we want to point out is it will be different. The conclusion will be different depending on the horizon. That's all we want to see. We want to see. So Vikas, if I didn't, say that point, please feel free to raise the question anytime.
Yeah, I guess you probably are going to talk about the estimation risk issue, but there is also a model uncertainty, which is that, the funds can actually also flip across factors. So you are talking about a single factor model so far, but let's say if you have funds, even in a single factor model, they could do timing, which actually makes their beta change over time to the market, but they can actually do factor timing and other things. So how does that actually play into this whole analysis?
Yeah, that's a very good point. As I have shown you in a so-called model, we have very simple model. In the model, we are assuming IID returns. That's going to make our assumption easier. If, as Vikas correctly points out, the even time of the market, the time of the factor models, well, that won't hold. That will make the relationship way more complicated. You are right. When I talk about estimation, I have to take that into account, right? We have to. But unfortunately, so far, we haven't, for a good reason. I would tell you, because why. When we do the estimation, we are still, we have to rely on the relationship between the true beta and the estimated beta. I mean, the long run beta, all right? And you are very right, the estimation is noisy, right? It's noisy because of many things. You already pointed out some. That's why we are trying to, in our estimation, we are trying to pull our estimated beta back to 1. That is, we are assuming there are lots of noise in our estimation. All right, even if we have some technique based on simulation. And also in our simulation, we still assume IID returns. You are right. And we believe this is something we could potentially improve. And we are planning to leave that challenge to future research, to be honest. So Vikas, did that answer your question?
Yeah, it does. I think it kind of boils down to this issue that there is a lot of heterogeneity among the active equity funds, and so I think your framework is sort of keeping in mind like a buy and hold sort of a long only sort of not doing many fancy thing type of a mutual fund. So if you actually split the sample of your mutual funds into different types, right? So some are more dynamic than the others, right? So that actually can perhaps give us some insights into, for what type of funds would this technique be okay, and for what type of funds. So that might be another way of thinking about addressing this issue, because analytically it would be hard to solve that, I guess.
Yeah, very good. Thank you for the suggestion. For the summary statistics, we did a lot of the cross-sectional sorting. For example, depending on their fund, depending on their life horizon. Also, we sort them into their beta, into the fees they charge, into the variance of their return and skewness. Mike, correct me if I'm wrong. We have done a lot of that, but for the beta sorting and alpha, we haven't. That's a good suggestion. We need to look into that. You're very right. The relationship, the findings could be different depending on the type of the fund. Thanks.
Thank you.
All right. If no question, let's move on to the challenging part. That is the estimation. How to estimate long horizon beta. Suppose you observe a fund which survived 10 years in the data in total. You have 120 months of returns, right? But now you want to know what is 120 months beta. The traditional time series regression won't work, right? Because you only have one data point. Some of you may say, well, you can still do annual beta, right? That's exactly what a previous study in the literature, when they talk about long horizon beta or alpha, they are talking about usually, a quarterly or annual. They don't go longer. The tricky thing is about the estimation, how to do that. So one choice obvious is, let's go back to the boring equation 6. All right. One obvious thing is you can estimate your short run beta, right? Monthly beta. You know this formula, you know the N, you know all those formulas. Just plug in everything. Well, you have the 120 months beta. Yeah, you can do that. But obviously, as Vikas correctly points out, a lot of estimation errors here, right? You're estimating the monthly beta, and we cannot even trust this guy. How could you trust this, 120 months beta? It's obviously noisy. It's one solution, but it's noisy. Then what we did, we said, essentially what we are doing is we try to give a weight to what you can get from the equation 6 by plugging in your estimated monthly beta in that equation. Give that a weight. Meanwhile, you give another weight to 1. It's kind of like the adjusted beta the finance industry people have been using. But how to assign those weights, that's a tricky thing. I will introduce a way, try to adjust the different weights. All right, it's long. Let me go through them one by one, step by step. All right. The first step in this, we are trying to, in a simulation, to estimate what should be the weight we give to your estimated, your implied long horizon beta, which is from equation 6 based on your estimate short horizon beta. All right. In the simulation, we try to estimate what's the true relationship between your true long horizon beta and your estimated long horizon beta. All right. Once we know from the simulation, if we know that true relationship, and we can then, based on what you have in the real data, your implied long horizon beta from your monthly beta, and then you apply this estimated relationship between your true long horizon beta and your estimated long horizon beta, then you're done, right? Essentially, you're assigning a different weight to one and your estimate beta. Let me tell you how we did this in the simulation. We first assign a true monthly alpha and beta to each fund in the simulation. And once you know the true monthly beta, you can also apply equation 6, right? And depending on other parameters, you assume that will give you your true long horizon beta. It will give you this guy, right? Your true long horizon beta, you know that. And once we assume your true monthly alpha and beta, you can then simulate, right? You can generate n months of returns depending on the true alpha and the true beta and other parameters. You can do that. And once you know the simulated data, you can estimate the monthly beta using the simulated data, right? You can do that. Once you estimate your monthly beta from the data, of course it's noisy, right? Because it's estimated. You apply that to equation 6 that will convert to a long horizon beta. But this is noisy, remember. It's based on the estimated monthly beta and equation 6. And then we repeat this 1,000 times. Once you do that 1,000 times for each fund, okay, 1,000 times, you will observe 1,000 long horizon beta, right? You will also observe 1,000 estimated long horizon beta, which is based on your monthly beta. Now we run a regression. Across these 1,000 simulations, we run a regression that will tell us what's the relationship. It's noisy, right? We know this estimation is noisy, but how could we use this noisy estimation to back out what's the true long horizon beta? We rely on this relationship. All right, that's I know this is something new to the literature and also new to us. If you have any suggestion, please feel free to let us know. This is what we estimated for each fund in our sample and at these 3 different horizons. At a 1-year beta, here n will be equals to 12. 10-year beta, n will be 120. Lifetime beta, that means for each different fund, the n will be different here. Now, for the annual beta, the relationship on average, alpha and beta on average is about 0.73. That means you give a weight of about 0.3 to the estimated long horizon beta based on your estimated short horizon beta. And the alpha hat is about 0.26. All right, and this relationship is definitely not perfect. As I mentioned, because the estimation has errors, right? It's not perfect, but the R-square is not poor, it's about 72%. For the 10-year beta, you can read the data, and the R-square now is about 83%. For the lifetime beta, similar. So that's our technique. It's new, and hopefully people can also apply to other situations, you know. Now, once we have that, you may be still wondering, hey, Feng, you know, you told me a new method. How could you convince me your method is not crazy, at least? We did the following sanity check. What we did, we can estimate annual beta based on our, so we call it a modified Lihari and Levi method, because we use their equation 6 to estimate long horizon beta. We call it a modified method. And you can also run a time series regression, right? To estimate annual beta. Here you just have your annual returns, that's it. But when we do this, we only look at the funds with at least 10 annual returns, just to reduce estimation errors. So what you can observe, that this is a monthly beta for this 4,000 funds. These are the annual beta based on our method and based on the conventional time series regression. You could say, well, obviously they are not exactly the same. Look at the median, standard deviation, skewness, they're different. But on average, we are pretty close, right? The average annual beta are really close to each other. All right, I hope I convinced you we created a new method, which is not crazy at least. All right, once we have this long horizon beta, we can do some interesting analysis to test. Remember, our key insight is the long horizon beta alpha and short horizon alpha will be different. And this difference will depend on the size of your true beta or short horizon beta. When your short horizon beta is greater than 1, long horizon alpha is worse than short horizon alpha. When your short horizon beta is smaller than 1, your long horizon alpha is better than your short horizon beta, alpha. Let's first look at beta. All right.
Hey,
Our
Feng,
model, yeah, sure, Scott.
Vikas has a question.
Sure, Vikas,
Yeah,
please.
hi, Fang. I was thinking about, can you go back to your previous slide? So
Oh, sure.
when you
This,
started your presentation, you were talking a lot about the skewness. And when you look at not this one, the next one, um, yeah. So here, if you see, the skewness is actually completely flipped here with the time series regression with the annual beta versus the method that you are using in the paper. So I was wondering, how does that, like, wouldn't it sort of affect the inferences you make about the uh, relative performance of funds to the market, relative to the market?
yeah, thank you, Vikas. So I think when we talk about skewness at the beginning, it's about the buy and hold returns actually. So because that's not about the skewness of beta. But you are very right here. It indeed flipped sign. If you look at a monthly beta, skewness is positive, and if you look at annual beta, still from time series regression is also positive, but now it's negative. Honestly speaking, we haven't really thought about this. We didn't thought about this, but my intuition is this. I think when we estimate this annual beta, we relied on that regression, right? The regression results. That regression results somehow smooths the beta. Any outlier betas which could increase your skewness, somehow we give it a weight, right? Remember, because we have this relationship, right? We have this relationship. This relationship will somehow at least reduce the outliers, which could give you a positive skewness. That's my intuition.
Yeah, so I think related to this issue of estimation risk, my understanding is that the extreme betas are always going to be estimated with a lot more noise. So if you have very high betas and very low betas, like the way I think people have shown for alphas too, for mutual funds or for any type of money manager, that when you look at the tails, you have less confidence about the the estimate that you have. So I was wondering about. So I think that's where this skewness thing would sort of come in as well, because you're talking about the betas in the tail. But anyway,
Yeah.
you can move on. I had another question which is totally different, which is, this whole problem becomes more complicated because of the fact that the fund managers decisions actually affect asset prices. So
Yeah.
essentially what happens then is that the premiums, the factor premiums, so to speak, are going to be not exogenous. It is dependent on what the fund managers do in the market. So there is a feedback effect here, which I think makes things more complicated.
Yes, yes, totally agree, Vikas. And so far, we're just, simplifying away that issue, to be honest.
Right.
We obviously didn't take that into account. So as I mentioned, this is a new method. And as I just talked about, our method only applied to a model with one factor, CAPM, essentially. We are thinking about this. Some genius guys will come in and improve this method, extend it to more, complicated models. So far, we're saying, let's do this and hope others will be improving that. Thanks, because this is great comments. All right. If you believe us, let's look at the estimation. Let's apply our method to the real data. We have the monthly beta here, the annual beta, and the 10-year beta and lifetime beta for all funds here. And if you look at the mean, of course, they are changing, right, over different horizon. And we also test whether the mean is different for the horizons of a 1 year, 10-year, or lifetime. Is it different than the monthly beta? It seems they are all different based on the mean. And actually, the average beta has been decreasing for all funds. Why it's decreasing? Remember, your long horizon beta not only depend on your short horizon beta, it also depends on alpha. And on average, I will show you very soon, on average, the monthly alpha is negative. That's why that's going to driving down on average your longer horizon beta. All right, on average, it will be smaller. So that's why if you compare this guy, for example, or this guy, 10-year beta, with the monthly beta, they are smaller. Actually, it doesn't mean that it must be smaller. Okay, they could be bigger depending on the size of the alpha and also the beta. So that's for all funds. When we move to those with beta, short run beta greater than 1, look at the beta. Again, they are different. And our model in the figure I showed you that on average long horizon beta should be greater than short horizon beta, right? This one should be greater than this one. But if alpha is 0, on average alpha is still negative. That's why driving down those long horizon beta. Still, if you look at the lifetime beta, it's slightly greater than the monthly beta. For the funds with the short horizon beta, monthly beta smaller than 1, the trend is clear. Look at this. So about 0.76 on average, then 0.75, 0.67, and 0.7. All right, it's decreasing. It's clear. More interesting, let's look at the alpha. All right, short horizon versus long horizon. Remember, what's our hypothesis and what's the thing we want to test? We want to test that over different horizon, the relationship between short horizon alpha and long horizon alpha should depend on the size of your beta. But before presenting that result, let's look at for all funds, with both short horizon beta greater or smaller than 1. The monthly alpha. Let's look at the median because they are outliers, obviously, because of estimation errors. Look at the median. For the median fund, the monthly alpha is about 5 basis points. Then it decreased to about 8 basis points, negative, sorry. And then 8 basis points at 10-year and 11 basis points at lifetime. If you look at the funds with alpha greater than 1, over a monthly horizon, about 41%, then 35%, 38%, 36%. If you focus on those funds with monthly SPY alpha great positive, that fraction shrinks to only 76%. That means among the funds who claim they have positive monthly alpha, actually only 76% of them have a lifetime alpha positive. That's what the data showed. But more striking results are here. As I mentioned, our key test will be whether the relationship depends on the size of the monthly beta. We first look at the funds with short run beta greater than 1. All right, let's look at their alpha. Monthly alpha, negative 8.5 basis points. It decreased quickly to 15 basis points. I'm looking at the median. I'm not talking about, the outliers, the median. So 15 basis points, then 23 basis points, then 32 basis points negative. You see the point? When your beta is greater than 1, your long horizon alpha will be worse than your short horizon alpha. That's exactly what the results tell us. If you look at the fraction of funds with beta greater than 1 have a positive alpha. At a monthly horizon, 36%. But if you look at lifetime, it's only 17% of them, shrink by a lot. If you focus on those with a positive alpha and a beta greater than 1, over lifetime, actually only 45% of them, they don't switch sign. Only 45% of them. That means for the remaining 55%, their alpha switches to negative.
Feng, you have a question from Dexing.
Sure, Deshin.
Hi, Feng. Yeah, really interesting so far. I have a question. So do you think some of it could be driven by like non-synchronous trading? So basically, like for example, if the fund return maybe like when they update these fund returns, there could be a little bit of staleness.
Yeah. So Deshin, how would that affect you? Are you thinking about that would affect your monthly alpha or your long horizon alpha?
So I'm thinking about the difference between the short term. So I'm thinking more in terms of betas, right? So actually, like the especially in some of the more illiquid asset classes, like the monthly betas may have not. So for example, when you calculate a betas using the monthly return, it may not incorporate the full information of the market returns. So
yeah,
that may lead to some underestimation of beta, I guess. So do you think some of it could be driven by that, like especially at the difference between the monthly and the 1 year?
Yeah, a very good point, Deshin. Let me answer that question this way. First of all, when we talk about a long horizon beta, we didn't estimate them from really long horizon return. You see what I mean, Deshin? It's still based on monthly returns because we started with monthly beta, right? And then we use what's the relationship between your short horizon beta and long horizon beta, the equation 6. We converted that. We are still using monthly beta essentially when we estimate long horizon beta. But you are right here. If that beta is underestimated because of non-synchronous trading, that will still affect our estimation of long horizon beta. But anyway, I want to point out our estimation is still based on long horizon monthly beta, and
so it will affect all your estimates across the horizons.
Yes, that will affect, but I'm not sure if it's equal. Probably not equally. That's the part I want to say. That will affect our estimation results, but how, that's going to be a bit tricky because if you underestimate your beta and the smaller your short horizon beta, that means even smaller will be your long horizon beta. That means our long horizon beta could potentially underestimate the true long horizon beta. So that's the implication I can see. And of course, you are going to also underestimate your monthly beta, right? But how would be those size? I don't know. Honestly speaking, I don't know, but it's a good point.
Okay, thank you.
Yeah, thank you. So
I have a question. So it seems like a lot of your focus is on the difference between short and long horizon alphas and betas based on the other thing. So based on the beta, what is the difference between short and long horizon alpha? Based on the alpha, what's the difference between short and long horizon beta? Dexing's question on trading of illiquidity, some of the other stuff raised, there must be other things that affect this relationship between short and long horizon alphas. For example, would the level of idiosyncratic risk affect it? Vikas mentioned factor timing. that would probably affect it. Those comparative static graphs that you had earlier, perhaps you could generate a few more of those based on some other variations that would affect this relationship.
Yes, totally agree. As Vikas also mentioned a bit early, he suggests us to do more, look at different types of funds. Yes, you're very right. We should do that, I think. Right now, our figure is really simple, IID return, right? We don't assume other things at all. To some extent, we already take the idiosyncratic volatility into account, I think, by giving different parameters. We can change the parameters depending on their idiosyncratic volatility. But yes, we should do that. Thank you.
You're welcome.
Yep. All right. So we have looked into those with a beta greater than 1, short horizon beta. Now let's look at those
Actually,
with a short.
Paul has a question before.
Oh yeah, Paul. Sorry, I didn't see that. Yep, Paul.
No, it's really just a comment. I think it was Sagata that was last talking.
Yep.
In the same spirit, if you wish to, it would be easy to say things like we look down on closet indexers, because we don't think they're going to getting credit for skill, but not really applying any skill. In this context, with lower idiosyncratic risk, their long-term performance might actually look better. So that's the only knob you give me so far, idiosyncratic risk. But being that it's about mutual funds, you could use Sagato's comment to make a lot of mutual fund observations that we might believe erroneously hold in the short term, don't hold necessarily quite so well in the long term. One way of looking at styles. I just thought it was a good point. I wanted to comment.
Yes, totally agree, Paul. Indeed, we look into the performance of an index fund versus non-index fund. In the paper, I think we report the results, but only at for the summary statistics, not for beta and alpha. You're very right. We should look into that as well. For
okay,
beta
I'm not
alpha.
critiquing you. I'm just asking you if you might consider doing more to really teach me more.
Yes, very right, Paul. Yeah, we should do that. Great. Now let's look at the beta, smaller than 1 sample. So with this sample, our prediction would be that the model tells us, oh, Clemens, please.
Yeah, just one question. It's related to some of the points that came up before. One thing I worry, or I wonder whether it's driven by like measurement error, like over longer horizons, you get this correlation between the beta and the alpha. A second point is about the economic magnitude. If I look at the ones with betas larger than 1, 32 basis points per month seems quite extreme underperformance. And the third point was just a thought experiment. Suppose you would do the analysis before and after fees. Like a fund might just charge a 1% expense ratio. And of course, there might be a compounding effect there, but I wouldn't expect the big effect with whether you do it on a gross basis or on a net basis. But your equations that you use, I'm not sure exactly how that would be reflected if you compare it on a net and gross basis.
Yeah, so yeah, Clemens, we haven't done that. We've done the pre-fee returns for the summary statistics, but not for the beta and alpha thing. Yes, and Clemens, you're right, and actually it's not trivial. You're very right. We should do this. Why? Because for the pre-fee returns, their alpha won't, maybe on average, not negative anymore. Remember, the long horizon beta will also depend on what? Not only your beta, also your short horizon alpha. That could change our results in a non-trivial way. I expect that. And you're very right here. This looks large, 32 basis points per month. It's really large. But well, we really don't have a real. If you look at the mean, it's even larger. But we want to de-emphasize that it's still large. We believe this is essentially, for some funds, their beta is really increased by a lot. That is, although they could have quite a big positive short horizon alpha, but actually their long horizon alpha is way smaller. That's what we want to say. All right.
So Feng, just a note about time. It's 10:45, and we should start trying to head towards wrapping up. Okay.
Yep, very right. I think I finished this. You can read this. That's exactly the opposite. When you look at a sample of funds with beta smaller than 1, that's exactly the opposite of the pattern. It's going to be increasing your beta, your alpha on average. All right, I'm going to skip these slides. And what's the conclusion? The conclusion, the punchline, we think is very simple. In the mutual fund literature, whenever you talk about the scale of the mutual fund managers or the performance, well, you have to think about what time horizon you should focus, because both beta and also alpha will be different depending on the return horizon. We should care about that. And also, this paper has lots of room for improvement. For example, we focus on one factor model, right? CAPM, you can expand that to multi-factor. And also, we assume IID. Yeah, this is not realistic. How could you improve that? Lots of things to do, but we hope we deliver the key message. Well, think about time horizon whenever you talk about mutual fund performance. Thank you a lot for all the great comments. Thank you.
Wonderful. Thanks, everyone. I'm going to stop the recording. If you have any other questions, feel free to stay online and we can chat after.
Yeah, please. I will be staying online. Thanks.